The Middle East powder keg. Volatility scenarios for gold and oil in 2026. The world is witnessing complex developments in the Middle East cauldron as direct military confrontations between Iran and opposing forces escalate. In economic theory and financial history, such events are not merely political issues, but powerful shocks that directly impact two strategic commodities: gold, the ultimate safe haven, and oil, the lifeblood of the economy. 1. Oil, supply shocks, and the Hormuz card. Oil is always the most sensitive commodity to fluctuations in the Persian Gulf. Iran, as the third largest crude oil producer in OPEC, holds a massive geopolitical advantage: the Strait of Hormuz. The risk of closing the energy artery. The Strait of Hormuz is a vital maritime route carrying approximately 20% of global crude oil consumption and nearly 1/4 of global liquefied natural gas (LNG). Iran's declaration of control or threats to close the strait in early March 2026 immediately pushed Brent oil prices past $80 barrel in just a few trading sessions. Two potential scenarios. Partial disruption scenario. Oil prices could fluctuate between $85 $95 barrel as insurance and shipping costs skyrocket due to vessels being forced to reroute around the Cape of Good Hope. Total blockade scenario. This is the nightmare scenario. If Hormuz is completely closed, the world faces a shortage of about 20 million barrels per day. In this case, Brent oil could easily break the $100 mark and approach $120 barrel, echoing the energy crises of the 1970s. 2. Gold, the rise of the safe harbor. Unlike oil, which rises due to supply chain disruptions, gold rises due to risk aversion. During conflict, when currencies and stocks become volatile, investors flock to gold to preserve capital. Record-breaking milestones. By early March 2026, global gold prices saw impressive leaps, surpassing $5,300 ounce and heading toward higher peaks. In the Vietnamese market, SJC gold bars also recorded violent fluctuations, nearing 190 to 191 million VN. Detail. Long-term forecasts. Based on data from financial institutions like UOB, the potential for gold volatility in 2026 is immense. Central bank momentum. Global central banks are aggressively buying gold to diversify reserves and reduce dependence on the USD amid geopolitical instability. Price targets. If the Iran conflict persists and spreads to regions like Lebanon or the Red Sea, gold is predicted to hit $5,800, $6,000 ounce by late 2026 or early 2027. 3. The resonance between gold and oil. The fluctuations of gold and oil during wartime do not occur in isolation but interact through inflation. As oil prices rise, global production and transport costs follow, leading to inflation. Since gold is the most effective hedge against inflation, rising oil indirectly pushes gold prices up. Panic sentiment. Images of missiles and airstrikes create waves of selling in risky asset stocks to shift into safe assets, creating massive buying pressure on the gold market. 4. Cooling factors to watch. Despite the upward trend, there are risks of local corrections. Stronger USD. If the Fed maintains high interest rates to combat oil-driven inflation, a stronger USD usually exerts downward pressure on gold. Profit-taking. After sharp rallies, like in early March 2026, profit-taking by large investment funds can cause temporary price dips. Strategic reserves. Releases of Strategic Petroleum Reserves, SPR, by the US and IEA members could temporarily ease supply thirst and slow down the oil price surge. Conclusion and outlook. The conflict involving Iran in 2026 is a maximum variable for the global economy. Oil. The upward trend is clear. $91 barrel is no longer a distant prospect if the Strait of Hormuz remains under red alert. Gold. The precious metal is entering a historic growth cycle. As the ultimate currency, gold is likely to set new records never seen before. Note: these forecasts are based on current geopolitical scenarios. Investors must closely monitor military announcements and central bank movements. As in wartime, news drives the market faster than any technical indicator.